Topic introduces credit default swaps, CDS, as one of the most widely used credit derivatives for transferring and managing credit risk. In a CDS contract, the protection buyer pays periodic premiums to the protection seller in exchange for compensation if a specified credit event occurs. Credit events typically include default, bankruptcy, restructuring, or failure to pay debt obligations. CDS contracts allow financial institutions and investors to hedge exposures without selling the underlying bonds or loans. These instruments improve market liquidity and provide flexibility in risk management. The CDS premium, commonly called the CDS spread, reflects the market's perception of the reference entity's creditworthiness and default risk. The topic further explains the mechanics and valuation of CDS contracts. The protection buyer makes regular premium payments until contract maturity or until a credit event occurs. If default occurs, the protection seller compensates the buyer for losses based on the difference between the bond's face value and recovery value. Settlement may occur physically, through delivery of the defaulted obligation, or in cash using market valuation methods. CDS pricing depends on default probability, expected recovery rates, interest rates, and market liquidity conditions. Higher CDS spreads indicate greater perceived credit risk. Financial institutions use CDS pricing models to evaluate counterparty risk exposures and manage portfolio credit risk efficiently. A key topic is the role of CDS markets in credit risk assessment and financial stability. CDS spreads provide real-time market-based indicators of changing credit conditions because investors continuously adjust prices based on economic expectations and borrower performance. Rising CDS spreads often signal increasing concerns regarding default risk or financial deterioration. During periods of market stress, CDS markets can amplify systemic risk because rapidly widening spreads affect funding costs and market confidence. Despite these concerns, CDS instruments remain valuable for hedging, speculation, and portfolio diversification. Regulators therefore monitor CDS markets closely to ensure transparency, liquidity, and appropriate management of counterparty exposures. Topic also focuses on CDS extensions and the development of credit indices used in modern credit markets. CDS extensions include basket CDS, first-to-default swaps, and contingent credit default swaps that provide exposure to multiple borrowers or customized credit events. These instruments allow investors to hedge portfolio risk more efficiently and gain exposure to broader segments of credit markets. Credit indices, such as CDX and iTraxx, consist of standardized portfolios of CDS contracts referencing multiple corporate or sovereign entities. These indices improve market liquidity, facilitate trading efficiency, and provide benchmarks for assessing overall credit market conditions across industries and geographic regions. The topic also examines the applications and risks associated with CDS indices and structured credit products. Investors use credit indices to hedge diversified portfolios, speculate on credit spread movements, or implement relative value trading strategies. Because indices represent broad market segments, they often serve as indicators of systemic credit conditions and investor sentiment. However, structured CDS products can introduce substantial complexity and leverage into financial systems. Correlation assumptions and model risk become particularly important when multiple reference entities are involved. During financial crises, rapidly increasing correlations and deteriorating liquidity may produce losses exceeding model expectations. Effective governance and stress testing are therefore essential when managing complex CDS-related exposures. Topic also introduces total return swaps, TRS, which are derivative contracts transferring both credit risk and market risk associated with an underlying asset. In a TRS arrangement, one party receives the total economic return of an asset, including interest income and capital gains, while paying a financing cost to the counterparty. The asset owner transfers exposure without selling the asset directly, while the receiving party gains synthetic exposure without funding the full purchase price. TRS contracts are commonly used for leverage, balance sheet management, and regulatory capital optimization. These instruments provide flexibility but also expose counterparties to credit and liquidity risks. The topic further explains collateralized debt obligations, CDOs, which are structured finance products created by pooling loans, bonds, or other credit exposures and dividing them into tranches with varying risk levels. Senior tranches receive priority payments and generally have lower default risk, while junior tranches absorb initial losses and offer higher yields. CDOs allow institutions to redistribute credit risk and attract investors with different risk preferences. However, valuation and risk assessment depend heavily on assumptions regarding default probabilities, recovery rates, and default correlations. The global financial crisis demonstrated that inaccurate modeling of correlations and excessive reliance on ratings can lead to severe systemic losses. Finally, topics highlight the growing importance of credit derivatives and structured products within modern financial markets. CDS contracts, credit indices, total return swaps, and CDOs provide institutions with powerful tools for transferring, diversifying, and managing credit risk exposures. These instruments improve liquidity and facilitate more efficient allocation of risk across market participants. However, they also introduce complexity, leverage, counterparty exposure, and model risk that can amplify systemic instability during periods of financial stress. Effective risk management therefore requires robust valuation models, strong governance frameworks, transparency, collateral management, and comprehensive stress testing to ensure resilience within increasingly interconnected financial systems.